Robert Prav _ head of Southeast Asia India Economics with Credit Suisse, joins us live from Singapore via Skype. Robert, good morning. Thank you for joining us. Robert, before we talk about India and what are your expectations from the RBI event next week, what is your take on emerging markets? Do you think emerging markets have hit some kind of a trading bottom because suddenly they've stopped hemorrhaging capital and most of the emerging market currencies have appreciated?
I'm not sure they have, actually, unfortunately. I'm not at all convinced this is over yet. It seems to be a pause. Obviously, we had some extraordinarily big moves in a very short space of time. I guess a pause was always going to happen at some point, and it seems to be happening now. I think as far as the fundamentals are concerned, they still generally favour the developed markets over the emerging markets, obviously, particularly in the context of tapering, which looks set for the September meeting next week. I would also, though, add that within Asia we have both developed and emerging market countries, and I would suggest that investors look north increasingly within Asia towards those developed markets of Korea and Taiwan, and also perhaps China, not that it's necessarily a developed market yet. I think that's where we're going to see the biggest upside, where the currencies are least vulnerable, where it's easier to play that stronger export story as well.
Robert, so where does India lie amidst all of this? Because it's a very crucial time ahead. We already know the kind of problems that we're grappling with in terms of economy, currency at all. We've got the Fed meet on 18th. The Reserve Bank back home as well is going to be meeting on the 20th with the new governor now at the helm.
Yes, a crucial time. Obviously, the governor has weaved his magic so far, as he's enjoying a very happy honeymoon. I think that's the way I put it right now. This appreciation that we've seen in the rupee in the last couple of weeks is partly a US dollar weakness story, but it's partly a Rajan related story as well. The question is, how long does that honeymoon last? And of course, as you suggest, next week is going to be crucial to that. If we get more tapering than the market currently expects, and to put a number on it, our US guys are looking for a 20 billion tapering, so slightly more than the market's anticipating. That could easily put the pressure back on some of these emerging market currencies, including the rupee. And then, of course, in terms of the RBI meeting itself, Rajan, I think, is going to have to say something more concrete about the currency, and hopefully to express his strong intention to stabilize that currency in a longer term sense, at the very least to keep in place those liquidity tightening measures that his predecessor introduced for as long as it takes, and to reinforce those measures if the currency starts to depreciate again, and if inflation starts to respond as well.
Robert, even though the widespread view is that Fed would taper come September, there seems to be a consensus which is gathering some momentum that Fed would taper, but they would taper light. If Fed indeed decides to taper light, what will that do to emerging market liquidity in the short term?
Well, in the very short term, obviously it would be a small net benefit for these emerging markets currencies, but my sense is that now, with the rally that we've had in some of these emerging market currencies, actually quite a light tapering should be pretty much priced in. I think the consensus view would be for 10 billion, 15 billion. So if we get that, obviously depending on the accompanying statement, then I would imagine we won't see a huge amount of action. As I say, our feeling is that the risks are towards a slightly bigger tapering than a slightly smaller tapering.
So what's expected, Robert, in terms of how the dollar is going to pan out ahead of the Fed meet? Because, again, that's a very crucial one. The dollar movement is going to dictate currencies for most of us.
Well, I can't say I have a particularly good or clear view about what the dollar will do over the next few days. Unfortunately, I'm not a trader. I'm focusing more on macro fundamentals. I guess it will just swing around on tapering expectations, clearly, which in turn, I guess, will depend on how the data between now and then come out, of which there's not a huge amount. Jobless claims today will be perhaps the key indicator to watch. But yeah, everybody clearly is very focused on that Fed meeting and how the data influences expectations around that. I think will be the key driver of the dollar.
Robert, final question. The August trade data for India was encouraging. Do you think that was a one-off and that is not going to sustain? Or in the short term, do you think imports will go down and exports will pick up?
Well, it's not just that month's data. We've had now 2 or 3 months of better data. We've had certainly 2 consecutive months where merchandise export values have shown double-digit gains. I think it is the start of something meaningful. And I think it reflects a combination of things. One, this improvement in the world trade cycle that is beginning to come through and is beginning to impact exports across the world, actually, not just in India. But 2, there is an India-specific factor as well, and that is the lagged effects of the rupee weakness. The rupee has been weakening since the middle of 2011. Our work suggests that it does take about 18 months up to 2 years for those effects to be fully felt. I think they're starting to be felt now, and I think we're heading into a period where export growth will surprise people on the upside. On imports, of course, there's a gold effect there. Obviously, imports were dragged down by restrictions on gold imports. I think gold imports generally will be a little bit stronger here, but that gap between export and import growth, I expect to continue. I think we're at the worst, over the worst, as far as both the trade deficit and current account are concerned, and I think we will end up getting a current account deficit around that 70 billion level.